like to introduce Ed Egel, Head of Investor Relations at WM. WM is based in Houston, Texas. It's the largest waste service provider in North America and has the largest landfill network. Ed joined WM in 1995 and has been his current role since 2014. WM has 400 million shares outstanding, trades around $230 for a $93 billion market cap and $23 billion of net debt. They should do about $26 billion in revenue this year, almost $8 to 9 billion in EBITDA, and about almost $8 in earnings. Ed, welcome, and thank you for being with us today.
Thanks, Tony. I appreciate the ability to present while not in person, virtually. So I appreciate you accommodating me still being able to present there.
That's great. Well, we're very happy to have you. Maybe at a high level, Ed, I know we've, I think people are very familiar with the brand. Obviously, you guys are pretty well known throughout the industry and throughout the U.S. But you could just at a high level tell us about what you do, maybe some more background.
So I want to start by kind of correcting a little bit that you said there for our guidance for this year coming up. We're going to be around 25.7-ish, kind of at the midpoint of our guidance on the revenue side, and about 7.550 roughly kind of at the midpoint for EBITDA, just to clarify that a little bit. But look, we're the North America's largest environmental solutions service provider out there. We have a large footprint in our traditional collection and disposal operations. Think of commercial, industrial, residential, picking up trash and disposing of it at our landfills or transfer stations. We're North America's largest residential recycling company as well. So picking up residential waste and sorting that at our facilities. We just acquired, and I'm sure we'll talk about this, a large medical waste business, Stericycle, that's going to add to our service offerings to allow us to have a more complete service offering to our customers. And we've dabbled a little bit in some technology and automation in our recycling facilities and our renewable natural gas projects. So those are all things that give us excitement going forward, looking into the future.
That's great. Great overview. Maybe we could talk about the pricing environment and give an update there. How have discussions with customers been going in a relatively inflationary environment?
Yeah, if you think about it, most of our customers understand that we have to recover our cost of processing or our cost to serve them. And a lot of times those customers, our service to them is less than 1%, particularly on the commercial side, of their business cost, right? So a restaurant, less than 1% of their service to them is what we're going to provide for them. So they don't really notice a lot of price increases across the board there. As long as you're providing the quality of service and providing differentiated service offerings to them, they're not going to really look at the pricing side of the business. So we try to focus on 100 to 150 basis points above our internal cost to serve those customers, above that to get pricing activities that are going to cover those costs plus get some margin expansion. We haven't seen much change in that. We focus on customer lifetime value here, meaning customers at our churn level in the commercial and industrial line of business of about 9% means those customers have been with us for 10 plus years. So they've gone through 10 plus pricing cycles. And we want to make sure that we treat those customers with the respect that they deserve and price them appropriately, cover our costs, but make sure that we look at all the data and analytics for those customers so that we don't intentionally shove them out of our portfolio. And it gives us a better view into how our service offerings combined with how our customers feel about us from our customer scores, it allows us to price more appropriately across the board. And we haven't seen much pushback just yet on that.
And could you, along that line, could you sort of discuss these higher value customers you talk about in regards to your ability to use maybe rollbacks, extended contracts?
Yeah, I think what we first look at is how can we become a better partner with those customers. So rolling back is a tool that you could have rollbacks and pricing. We don't like to go there, but we really look at how can we partner with them to increase the service levels that they have with us, right? So they might just be a customer that just has a commercial can with us. How can we add recycling services to them? Or how can we add organics processing or some other service levels there to increase the stickiness of those customers across the board? We do have the toolkits, have to roll back prices, but we don't use that as the first lever. We look at kind of being that long-term partner with them to create value across the board for both us and them.
And then, discuss your ability for, price discovery using your tools, strategies that you have with customers, sort of maybe some of the pricing tools you guys have.
Yeah, so we go back a long ways, particularly on the commercial and on the collection and disposal side, right? We've been gathering data. We've had onboard computers on our trucks for a decade plus right now, gathering information about how we service that customer, how long it takes to serve the customer, any operational issues we have with them. We also now use that technology to track kind of what their waste looks like as we're dumping into the back of the truck, right? So we know if they have a recycling can, for example, what their contamination level could look like. So we can provide that data back to them to help them understand why we are pricing the way we are. As everyone's aware of, labor costs continue to go up, inflationary environment still around today. That's the easy bread and butter that people understand. It's really trying to get the customer to understand what we know about them and how we can provide the valuable service to them and how we can help them become a better customer for us if they're recycling appropriately or throwing the trash away the right way.
And Ed, in capturing this price, how does that translate to incremental margin improvement?
So again, we'd like to get that 100 to 150 basis points above our cost to serve those customers, so we get that margin expansion across the board. It varies depending on lines of business, right? So you look at our open market business, which is about 60% of the pricing, 40% is tied to some sort of index on there, and we look to see what those returns are. Both on a margin basis and a return on invested capital. I'm sure we'll talk about residential a little bit and why we're shedding some of the volume there, but that's why we look at that, to make sure that we get that expansion that we expect to earn and our investors want us to see.
Yep, and you led me to my next question. Maybe talk about volumes now, and discuss what you've seen in churn rate and what has the trajectory sort of look like.
Yeah, so we don't really give inter-quarter updates, but I'll tell you from our fourth quarter earnings call, churn was reasonable, around 9%. We've seen it in that 9% level for a long period of time, and we're proud of as a reflection of our service offering, right? Pricing isn't a reason why customers leave generally, it's because of the service failures that we potentially have. So keeping that at 9 is really good outcome for us. We'd love to see it a lot lower than that. Part of it's structural, that you'll never be able to get rid of. Businesses just go out of business once a year. So getting it lower would be opportunistic for us and provide better value. From a volume perspective, for the full year, we guided volumes to about 0.25 to 0.75% in the collection and disposal business. That's about 50 basis points at the midpoint. I'll point out that all of that 50 basis points is really coming from the cleanup in California. Unfortunately, in Southern California, the wildfires, that volume is about a 50 basis point impact to us positively. That means the rest of our business is going to be essentially flat from a volume perspective, but you really need to pull back the layers on the different parts of our business. Commercial business seems to be doing okay, particularly with national accounts. We're seeing attracting those customers at better pricing and providing value to those customers. MSW landfill volumes seem to be going okay. Really, the intentional shedding of the residential volumes are going to drag that down, and we've been about 3% negative over the last 8+ quarters there. And we've talked a little bit about on our industrial side, seeing a slowdown both in housing and kind of the industrial services sector a little bit. We talked kind of, are we in a mini industrial recession right now? Don't necessarily want to call it that, but we've seen in the last 2 or 3 quarters negative volumes in the industrial side that gives us a little pause that there could be some challenges in that volume aspect going for the rest of the year.
Yeah, and then Ed, you alluded to the shedding volumes. Could you sort of talk your decision matrix, maybe for those less familiar? It obviously is a little bit of counterintuitive, but just maybe talk about how you go about deciding about shedding those, and maybe talk about the national accounts business.
Yeah, so the shedding really comes from the residential line of business. And if you look probably 5-6 years ago, before we started this process, operating EBITDA margins in that business were in high single digits, low teens, maybe call it 8 to 12% EBITDA margins. And we looked at why is it that the case, right? I mean, these are large chunks of business that we should be able to get better returns on. There's no competition as you have these 5 to 10-year contracts. So looked at it, a lot of it comes down to price escalators, right? A lot of them are tied to CPI, CPIU, water, sewer, trash, things like that weren't keeping up with our cost of inflation. So as John Morris says, the first day of the contract winds up being the best day of the contract right? Because our costs continue to escalate, but our price escalators aren't keeping up with it. So we made the decision to start looking at that, looking at automating the residential line of business, right? Going from rear loads to automated side loaders, reducing the dependency on labor there, increasing efficiency, reducing safety incidents, as well as making sure we had the right price escalators in those contracts. And as I mentioned, we've seen a decline of 3+% kind of quarterly for the last 8 to 10 quarters. However, what I'll tell you is our revenues continue to grow because we got the right pricing escalators in there, and we've seen our EBITDA margins grow to close to 20% EBITDA. Now, we don't want to get rid of all of our residential business, right? We want to make sure we get the right returns and that business competes for capital just like the rest of our businesses do.
That's a great overview. Thank you for that. Maybe switching to special waste. Obviously, there's a lot going on. And some previous presenters talked about what they're seeing. What are you seeing there? Is there some pent up demand? Maybe what your pipeline looks like?
Yeah, the pipeline looks strong and robust. It really comes down to when the municipality or the agency is going to want to let those contracts out, basically, right? So you could see delays, right? In the first quarter, you'll normally see a little bit lower special waste volume, right? Just the nature of our business, the cyclicality of it. But that doesn't mean those jobs are gone away. It just means there could be a delay of when we start seeing those volumes kick in. Our special waste volumes are really strong over the last couple of years, and we think that will continue. It's just a matter of timing-wise when people feel comfortable that they're wanting to continue those projects.
Yeah, and then maybe over to C&D. You're the largest, obviously, operator. What are you seeing currently in the real estate market, and then maybe what's maybe your outlook looking forward?
Yeah, right now I think the construction and demolition side is a little bit weaker for us, and that's primarily because we don't play in the temporary housing side, right? We're focused more on the permanent side of the business. We do have obviously temporary C&D business that we do on the industrial side, but it's not that big. When you look at the landfill volumes, they have been negative here a little bit, and see that as continuing a little bit further.
And then switching over to RNG, I saw you had a great press release last night with your RNG facility update. Maybe you could walk us through that, and then just sort of maybe talk a little bit more about that business for you.
Absolutely. I think it's a great opportunity for us and give us a lot of excitement over the next several years. We've been on this journey, investing about $1.6 billion by the time this tranche is finished. It'll be about 20 projects that we'll have up and running, generating about 25 million MMBTU of renewable natural gas. Right now, we've had about 7 projects complete through 2024. Got about 8 more coming online this year, and then the remaining 5 will come on in 2026. So we'll be at the full run rate, in 2027. That's going to generate $650-ish million of revenue at about $500 million of EBITDA, rough numbers. $26 per MMBTU is our blended average that we're using for that. That equates to about $2 a RIN and $2.50 for natural gas. I should point out that that's a blended average across all of our sales. Part of those sales are going to go into the voluntary market, which might be a little bit lower than the $26, which means the RINs market will be a little bit higher than 26, so that we get the full blended average of $26. Really great investment for us. 3-year payback on average without the investment tax credits, and we expect about $220 million or so of investment tax credit benefit this year as well. So really strong returns, strong profile, feeds our natural gas fleet, and there's a lot of appetite as potential onshoring of manufacturing. You have data centers coming on board. There's going to be a lot of energy needed, and our volume at these facilities could provide some of that needed energy.
Yeah, that's a great review of that, and maybe you could discuss some of the advantages that you have as the largest, obviously, landfill landfill owner, and the scale advantage that come with that in this business.
Yeah, absolutely. So again, these projects, we've been in the landfill gas to energy business for over 3 decades right now, and it was really capturing that naturally occurring methane, converting it into electricity for the longest time, right? Today, because of our natural gas fleet, and we might talk about this a little bit later, but we knew that natural gas fleets wouldn't necessarily be the be-all, end-all kind of for carbon reduction across the board, but we took the opportunity to take the first step and reduce our emissions through natural gas. Well, when the RFS came out, we saw the opportunity there to continue to fuel our fleet and generate these RIN credits. We have the expertise because we've been doing this for so long. We have the balance sheet capacity to do this, and we have the strength in our operations to weather some fluctuations in commodity values. And we're working on making sure that we have the appropriate level of risk built into our any given year, where we're going to have 80 to 90% of that volume kind of locked up in longer term contracts. Over a 3-year period, about 50% of the gas will be locked up, so we can still participate in any upside that we see in the RINs value. But we're well positioned based on our landfill footprint, our expertise, our natural gas trucks. All that really leads us to why we decided to go about it the way we did.
Yeah, it's a natural fit for your company. Maybe switching to recycling, your recycling plant investment, because maybe give us an update there, and sort of what are you seeing in the supply and demand side of that business?
So we went similar to our renewable energy side. We're investing about 1.4 billion in a recycling outfit for really automating our facilities. We have, by the time we're done, we're going to have automated virtually all of our single stream recycling facilities, about 26 plants that will have fully automated. The good thing about this, it's really not dependent upon commodity values, right? Because all of the value that we're getting from these new upgraded automation plants, or 60% of the value, I should say, is coming from reduced labor cost and improved throughput. And we're also going to get some value for selling cleaner material, right? So we get a premium to our normal sale of material, right? So you have cleaner bales of cardboard, cleaner bales of paper, you get a premium to that. So that's really where that value is driving. So the commodity price doesn't really impact that, and we're well along the way on that side. As far as the rest of the investments that are coming in from new marketplaces where we're going to invest in new plants, a couple of things I'll point to examples here. Austin, Texas, for example, we didn't have a recycling facility there. And as migration occurs from California to Texas or New York to Florida, where we don't have this infrastructure, we're investing in that infrastructure to meet the demands of our customers on that side. And then the other investment that we're making is on EPR. We've won a couple of projects up in Canada, in Ontario. As extended producer responsibility comes to the US, you're seeing it in California and in Colorado, and primarily on the West Coast, we're well positioned to capture that volume opportunity as well. As far as what we're seeing right now, recycling comes down to two things: making sure our customers upfront understand what they should be recycling, right? So we still see a lot of contamination in those loads, call it mid-teens kind of contamination there. But we're also still seeing a lot of the PET bottles going into the landfill. So what can we do to educate our customers to get that material through our plants, as well as the back end, having that demand from the consumer packaged good companies wanting to use that recycled content is key as well, right? So, and it's still pretty strong there. And then when you have legislation like minimum content legislation coming on board, that's going to help drive the demand on the back end. So EPR, minimum content legislation, all of those things will help drive the back end. We still need to focus on the consumer up front to make sure they recycle the right way. But this is a good marketplace, and it's going to enhance our leading capabilities here.
That's a good overview. Maybe talk about automation. I know Jim a couple of years ago, sort of brought up some pretty big numbers on, you were saying, with labor improvements. How is automation going to benefit you guys in the coming years on an operational basis and economics?
Yeah, that's a great point, and that's what we're seeing here on the war on talent, right? You have to attract drivers, you have to retain those drivers, mechanics, things like that. So what we realized is there's a lot of talent out there that we're using through third-party services, not necessarily WM employees, that have high turnovers. And I'm not talking 14, 15%, I'm talking 50, 60, 70% turnover in some of these positions. So what can we do to automate that? So the one area we talked a little bit about is on automation of residential rear load routes, going from rear load to automated side loaders. You can eliminate 1 or 2 helpers off the back of the truck that are contingent workforce, basically. You improve your safety because you don't have to worry about that helper getting off the truck and getting a soft back issue because they're lifting this 75-pound can into the back of the truck, and you don't have people standing on the back of the trucks where the public's out there driving around. And they're about 30% more efficient. You can pick up 30% more of quicker using an automated than you can on a rear load, right? So that's one area. We have about 4,000 routes that we could convert or that are still rear load. We're about about half of that, a little more than that, we'll be able to convert to the automated side. Right? Things like yard waste, you're not going to be able to convert because everything has to be containerized. So there'll still be some need for real load routes. Other things on the recycling, we touched on the recycling investment, seeing about a 30% labor efficiency improvement in those plants by automating, right? We have a plant here in Houston that we've taken investors to, where before we automated, we probably had 3 shifts of 36 to 40 employees kind of sorting through materials. Today, I've got 3 shifts with 36 employees total in that plant, right? And those are hard to fill sorters on those lines, right? That have a contingent workforce background, right? They're not necessarily WM employees. And then the last area I'll talk about is kind of on the technology side is on routing and logistics, right? What can we do to improve our efficiency, right? Making sure that our drivers are following the routes appropriately, that we're able to add in on-demand services or roll-off customer calls in today. And, years ago, as you said, I started in 95, 30 years ago. I remember having push pins in the back of dispatch. And if the customer called in for a change, you had to take all the pins out and we're kind of reroute. Well, now can we do that dynamically, right? And the driver goes out on the route today. There's 80 different decision points potentially that dispatcher would have to consider when they decide who's assigned that to. Well, let's let the computer do that and let the driver just know, okay, here's my first stop today. And then when they confirm that stop, the next stop pops up, right? So no one knows really what's the future stops are going to be, but it's just more efficient for us to do that. So those are some of the things that we're doing. We've also automated some Salesforce and how we go to market. And then call centers is the other thing that we've talked about for years of, reducing the number of call centers and having customers be able to self-serve using technology.
That's a wonderful overview, and got AI in there too. I like it. Stericycle, obviously you guys have been in the medical waste business for a long time. This obviously this asset came to market. Maybe the strategic thought process, why now? Maybe just give us a review of that and then an update on how the integration is going.
Yeah, absolutely. We've been very interested in the Stericycle business for a decade or so, right? And if you go back to that point in time, we were probably a 12 billion market cap company. They were an 8 billion market cap company. If we combined it, it's going to be a bet the company transaction. When we did this deal, we were $80 billion market cap and they were 4 billion, right? So it's not a bet the deal transaction at this point in time, or bet the company transaction, I should say, at this time. Really what drove us to finally, make this acquisition is really the inflection point that this business is at, right? They've had, they've lost focus sometimes on buying companies that they shouldn't have been bought, investing in those companies, not really focused on running the business as much as possible, trying to clean up that portion of the business that really didn't make sense for them. You see them going through an ERP journey today, right? And trying to get that implemented. We've gone through our ERP journey and we know how to fix that and make sure that it's running appropriately. I think there's an opportunity set here to take what we've learned from our pricing programs and apply it to their business once we have that data. We understand the data, and once you start collecting it, we're going to be able to apply it to their business. And we think that this business really is going to have potentially a higher growth volume rate than the collection and disposal business, right? If our collection and disposal business is trading at some discount to GDP or volume, right? Call it 50 to 75 basis points of GDP. We think you could see a faster growth rate on the medical waste side as the population continues to age, right? So it's really a strong inflection point here where we think we've got the opportunity to take what we know from a traditional collection and disposal business, because that's what the Stericycle business is. It's route-based, picking up medical waste and disposing of it, and applying that, what we've learned. Now, different trucks, different processes how to do it, but we know how to collect and dispose of waste. So applying that to that business is really going to be beneficial. And then add on top of that, we double our synergies from 125 to 250, right? A lot of that's going to be coming from SG&A, and that's going to bring their SG&A roughly to about 16% of revenue. As you know, today we're running around 9%, right? So in 3 years from now, there's probably more opportunity to get that SG&A a little bit lower. None of these synergies contemplate cross-selling opportunities as well, right? There's additional revenue opportunities here. WM has a low single-digit percentage, probably underrepresented customer mix in our commercial and industrial line of business in the medical waste services field, right? So whether it's hospitals or doctors' offices, dentists, tattoo parlors, things like that, we don't service that as much as we probably should based on our size. So there's a whole opportunity there for us to provide a value proposition to those customers to show how we can offer them medical waste, solid waste, recycling, organics, whatever their needs are, to become a partner with them, just like we did with the national accounts business. And you see how well that's worked for us. We continue to grow that business, higher pricing, higher EBITDA on that business, and we can take what we've learned from that business and apply it to the Stericycle business to continue to grow there. I should throw in my plug here. Well, we haven't given anything on revenue just yet, but in June we're going to have our Investor Day in New York City. So more to come on potential opportunities from the cross-selling opportunities then.
I'll see you there for that. Maybe I'll open it up to the audience for questions.
Hi, thank you. You spoke about RNG. You spoke about your automation on your routes. Can you talk about electrification with your trucks, particularly for recycling, where it's defined radius and a lighter load?
Yeah, absolutely. So we are testing the heavy duty equipment to see where we can use it. That would be a market. We do have a large fleet of light duty trucks, right? Support vehicles that we can definitely electrify. The Stericycle business is an opportunity, box trucks to electrify. From the solid waste perspective, we haven't seen the full duty log necessary to service our customers. We think we'd have to add a bunch of routes potentially in certain locations because of the trash side. On the recycling side, again, we're still testing it to see. Electrification is going to come and it's going to work eventually, but we just want to make sure that we're thinking about it the right way. I mentioned that we have the largest natural gas fleet right now, and we replace about 10% of our fleet every year. So over a 10-year period, if we get to a point where electrification is the best opportunity, we can switch our fleet pretty quickly over that 10-year period, as well as we could, if we needed to, retrofit some of these natural gas plants to go back to electricity, right? So that's one of the things that I didn't use as why we're doing the RNG projects the way we're doing them. We have flexibility to change kind of how we want to designate those plants if it comes around that electricity is better at that point in time. So just another benefit there.
And then maybe we should just touch on tariffs. Obviously, it's such a timely topic here. How are you guys looking at tariffs after yesterday's announcement?
Yeah, I think you could see it potentially impacting capital spending, right? As that's where you'll see it first. Don't necessarily believe as a North American company we'll see a lot of tariffs impacting us. The good news is if companies see their business slow down, particularly in commercial, that's really not going to impact us as much, right? Until those customers go out of business, right? COVID is kind of a good example of that year, right? As businesses slow down a little bit, we still perform very well because you don't lose that volume, right? It's still, you just have less volume. It's better for us from a disposal perspective that you don't have, you have emptier cans. So I don't see necessarily a big impact on the collection side of the business from that perspective. The good news, you could see some benefit on the recycling side, on the commodity side, as demand stays within the U.S. for recycled content. You could see commodity prices go up a little bit higher there. So still early to tell, but I think capital spending will probably be one where you see some inflated prices, and then you could see some benefit on the recycling side.
And then maybe to get one more into capital allocation, could you sort of just walk through your capital allocation strategy, buybacks, dividend, debt pay down, M&A?
Yeah, absolutely. In a normal year, we would say, and we've raised our dividend 25 years in a row. We grew at 10% this past year. I think dividends are first and foremost. We're going to pay those first, and then what's left over, historically, what we've done is look to grow the business through either M&A activities or organic investments like our recycling, renewable energy investments we've made, and then share buybacks would be last. Debt repayments in a normal year would normally not be something that we would do because our cost of debt is so cheap. Right now, because of the Stericycle transaction, our leverage ratio is a little bit higher than we want it to be. So 2.5 to 3 is kind of the range we like to be at. We expect that by the end of this year to be about 3.1 times, and then by early next year to be at a range in that range so that we can restart our share buybacks. But it's still going to be dependent upon what the M&A market looks like and what internal investments we can make to continue to grow the business.
Well, Ed, thank you so much for the time. I know everyone wants your time, and appreciate you supporting us all these years, and hopefully get you back next year. Thanks so much.
Appreciate it. Thank you. Have a good day.